to wealth ideology journey. It's a mindset where strategy, hard work, and smart decisions lead you to success. Get ready, because only those who think big will win. Stock market crashes can be terrifying. One day, everything seems fine, and the next, prices are plummeting, investors are panicking, and the media is filled with doomsday headlines. But here's the truth. Market crashes are not the end of the world. In fact, they are a normal part of the financial cycle. The key is to understand why they happen, how they impact your investments, and most importantly, how you can protect yourself or even profit during these times. In this video, we'll break down everything you must know about stock market crashes so you can be prepared for the next one. Part 1. What causes a stock market crash? A stock market crash is often a sudden and catastrophic event where stock prices plummet rapidly, leading to widespread panic. The core cause of a crash is usually a loss of investor confidence, which triggers a massive sell-off. But what exactly sparks that loss of confidence? It's typically a combination of different factors that converge to create the perfect storm. Economic downturns or recessions are prime culprits, as they signal a slowdown in growth and profitability. When people anticipate that businesses will not perform well in the future, they may decide to sell off their stocks before their value drops further. Another major factor is rising interest rates. When the Federal Reserve increases interest rates, borrowing becomes more expensive, which can negatively affect business growth and consumer spending. This can lead investors to reassess their outlook on the market, resulting in a sell-off. Geopolitical tensions, such as wars, political instability, or trade wars, can also create uncertainty in the market. Part 2. How a stock market crash affects the economy. A stock market crash has far-reaching consequences that extend beyond just the investors directly affected by the decline in stock prices. While the immediate impact is often felt by those holding stocks, the ripple effects can reverberate throughout the entire economy, affecting nearly everyone. As stock prices fall, the value of companies declines, which can severely hurt their financial standing. In response to these challenges, businesses may be forced to make difficult decisions in order to survive, such as cutting costs, freezing hiring, or even shutting down entirely. This leads to job losses and a decrease in overall employment, further contributing to the economic downturn. The knock-on effect of reduced consumer confidence and increased uncertainty causes people to spend less, which can exacerbate the economic slowdown as businesses experience reduced sales and profits. For those who rely on investments for retirement or as a primary income source, a stock market crash can be particularly devastating. Part 3. The psychology of a market crash. The psychology behind a market crash is often driven by fear, which becomes the dominant emotion as stock prices begin to fall. As market declines unfold, the instinct to protect one's investments kicks in, and many people panic, hastily selling off their assets to avoid what they perceive as even greater losses. This reactionary behavior stems from the fear of losing everything, and it's amplified by the widespread media coverage of market turmoil. However, there's a dangerous paradox at play. The more people sell, the deeper the market declines. The herd mentality takes over, where investors follow each other's actions instead of thinking critically or logically about the long-term outlook. A small market decline can quickly snowball into a full-blown crash when panic spreads like wildfire, exacerbating the downturn. In these moments, emotions cloud judgment, and people make decisions based on short-term fear rather than long-term strategy. Part 4. Historical stock market crashes. Throughout history, the stock market has experienced several devastating crashes, each leaving its mark on the global economy. However, one constant remains: the market has always recovered. The Great Depression of 1929 was one of the most catastrophic crashes in history, wiping out fortunes and causing widespread economic hardship. The aftermath of that crash led to a prolonged period of economic suffering as unemployment soared, businesses closed, and consumer confidence plummeted. Yet, despite the deep scars left by this crisis, the market eventually found its footing, and the US economy gradually began to recover, albeit slowly. Fast forward to 2008, when the global financial crisis struck with equal force, triggered by risky mortgage lending practices, banking failures, and a collapse in housing prices. The financial system was on the brink of collapse, and many believed that a full-scale economic meltdown was imminent. The crisis led to massive government bailouts, a recession, and widespread job losses across industries. Part 5. Why market crashes are not the end. It's easy to think a stock market crash means total financial ruin, but that's rarely the case. Every crash is followed by a recovery. The market moves in cycles, and those who stay patient often come out ahead. Look at any long-term stock market chart. You'll see dips, crashes, crashes and recoveries, followed by new all-time highs. The key is to think long-term, not short-term. Part 6. What you should do during a market crash. The worst thing you can do in a crash is panic sell. Selling at the bottom locks in losses, while those who stay invested often recover their money over time. Instead, stay calm, review your portfolio, and focus on strong investments. If you have extra cash, a market crash can be an opportunity to buy high-quality stocks at a discount. Part 7. The best investment strategies during a crash. During a crash, certain strategies can protect and grow your wealth. Diversification, spreading your investments across different industries and asset classes, helps reduce risk. Dollar cost averaging, where you invest a fixed amount regularly, allows you to buy more shares when prices are low. Holding dividend-paying stocks provides passive income even in a downturn. And if you're a long-term investor, a crash is a buying opportunity, not a disaster. Part 8. The role of the government in market crashes. Governments and central banks often step in to stabilize the market during a crash. They may cut interest rates, provide stimulus packages, or introduce policies to restore confidence. For example, during the 2008 financial crisis, the US government bailed out banks and injected money into the economy to prevent a total collapse. Understanding these interventions can help investors predict market recoveries. Part 9. Warning signs of a market crash. While no one can predict the exact moment a crash will happen, there are warning signs to watch for. Overpriced stocks, rising interest rates, high levels of debt, and extreme market speculation often signal trouble ahead. If people are investing blindly, assuming stocks will always go up, it's usually a sign that a correction is coming. Being aware of these signals can help you prepare before a crash happens. Part 10. How the wealthy benefit from market crashes. While most people fear market crashes, the wealthy see them as opportunities. They use crashes to buy undervalued assets, invest in real estate, or acquire businesses at lower prices. Warren Buffett's famous advice is to be fearful when others are greedy, and greedy when others are fearful. The rich don't panic during crashes, they take advantage of them. Part 11. Preparing for the next market crash. The best time to prepare for a market crash is before it happens. Make sure you have an emergency fund, avoid excessive debt, and build a diversified portfolio. Learn about investing so you can make smart decisions when the market drops. Most importantly, develop a long-term mindset. Market crashes come and go, but those who stay patient and prepared always come out ahead. Stock market crashes are a natural part of investing. While they can be scary, they also create opportunities for those who understand them. By staying informed, keeping a level head, and thinking long-term, you can protect yourself and even grow your wealth during a downturn. Don't let fear control your financial future. If you found this video helpful, subscribe to my channel for more investing insights and financial strategies. Stay smart, stay prepared, and I'll see you in the next video.